Hey everyone, welcome. So today we're going to dig into a weird paradox, something a lot of us are feeling right now. You look at the stock market and it's just soaring, right? Hitting new highs, making retirement accounts look great, at least on paper. But then you go to the grocery store or you fill up your car with gas and it tells a totally different story. So what gives? Are we actually getting richer? All right, let's get into it.
And that's really the big question here, isn't it? On one hand, you've got these numbers on a screen telling you your investments are crushing it. But on the other hand, your day-to-day experience is screaming that your money just doesn't stretch as far as it used to. It's this disconnect that we're here to unravel. Is this a real, genuine economic boom? Or is there something else going on behind the scenes?
So, to kick things off, let's just take a moment to look at the spectacle itself. I mean, the market's performance by any standard measure has been nothing short of staggering. But this is exactly where the puzzle really starts.
I mean, just look at this number. Over the last 5 years, the S&P 500 has skyrocketed by more than 94%. Now, to put that into perspective, the historical average return for a year is about 10%. So we've essentially crammed almost a decade of average returns into just 5 years. It's been an unbelievable run. But you have to ask, is it too good to be true?
Because while the market was on that absolute tear, this has been the reality for pretty much everyone else. The dollar is losing its punch, and more importantly, its purchasing power right here at home is shrinking. Everything just feels more expensive. And this is the contradiction we're all living through. Our assets are priced higher in dollars, but every single one of those dollars is buying less.
So what on earth is causing this split? To really get it, we need to pull back the curtain and look at the engine that's been pouring fuel on this market fire. A massive, massive injection of new money.
Okay, so this chart here shows what's called the M2 money supply. Think of it as basically all the cash, checking deposits, and other money that's easy to spend. Just look at those insane spikes, especially after the 2008 financial crisis and then again during the 2020 pandemic response. To deal with these crises, central banks have basically opened a fire hose, pumping trillions of brand new dollars into the system. This is not a small tweak, this is a flood of new cash.
So how does this actually work? Well, it's kind of like a three-step dance. First, the central bank essentially creates money out of thin air to buy things like government bonds from the big banks. Step two, this gusher of new cash floods the banking system and pushes interest rates way down, making it super cheap to borrow money. And step three, where does all that cheap money go? It doesn't just sit around. It goes hunting for returns, and a whole lot of it flows right into financial markets, bidding up the prices of stocks. So the key takeaway here is that a rising market isn't necessarily a sign of a healthy economy. It could just be a sign of way more money chasing the same assets.
And this brings us to a really important idea called the Cantillon effect. It's named after an economist from way back in the 18th century. And what he figured out is that new money doesn't spread through the economy evenly, like pouring water on a table. Nope, it gets injected at specific points. So the people who get it first, think big banks, giant corporations, anyone really close to the financial spigot, they get to spend it while prices are still low. But as that new money works its way through the system, it pushes prices up. By the time it trickles down to the average person as a paycheck, prices have already gone up. So they get hit with the inflation, but they completely missed out on the initial benefit.
Now, this whole idea wasn't just spotted by Cantillon. There's an entire school of economic thought that's been shouting from the rooftops about these effects for more than a century. They're known as the Austrian school, and their critique really gets to the very heart of our question today.
Two of the biggest names you need to know here are Ludwig von Mises and Friedrich Hayek. These guys were really skeptical of central banks trying to manage the economy. They basically argued that messing with the money supply has all these dangerous, unintended consequences that can warp the whole system.
And this quote from Mises, wow, it just cuts right to the chase, doesn't it? The Austrian argument in a nutshell is that when a central bank creates a boom by just printing money, it's not creating real, lasting wealth. It's creating an illusion of wealth, tricking people and businesses into making bad decisions based on signals that aren't real.
So let's put these two views side by side. The mainstream view, which is what most central banks follow, says that this kind of money injection can give the economy a much-needed boost during a downturn. But the Austrian view? It says that stimulus is actually more like a poison. By making credit artificially cheap, it fools businesses into investing in projects that only look profitable because of the cheap money. They call this malinvestment. And it creates this fragile fake boom that's just destined to bust as soon as the cheap money party ends.
Okay, so theory is one thing, but how can we actually test this? How do we separate what's real growth from what's just an illusion? Well, it's actually pretty simple.
We just have to adjust the numbers for the very inflation that all this money creation caused in the first place.
So first up, here's the S&P 500 chart in what we call nominal terms. This is the one you see on the news every night. It's that beautiful, rising line that makes you feel like everything's awesome and we're all getting richer. But the problem is, this chart completely ignores the fact that the dollar itself is losing value.
Now, watch what happens when we adjust that same chart for inflation. The picture changes completely. That smooth ride up suddenly looks a whole lot bumpier and, frankly, way less impressive. You can see these long stretches where, in terms of actual buying power, the market basically went nowhere or even lost ground. And that huge spike we've seen recently, a big chunk of that gain just evaporates. This right here, this is the illusion of wealth in a single chart.
Here's another reality check. It's called the price-to-earnings ratio. It just tells us how much investors are willing to pay for $1 of a company's profits. Now, the 40-year average is about 14. Today, it's almost 29. Let me say that again. We are paying nearly double the historical price for the exact same amount of profit. That is a textbook sign of a market that's overvalued. Probably not because companies are twice as good, but because there's just too much money chasing them. So what do smart investors do when they start to worry that their currency is losing value? A lot of them run to hard assets. And get this, over the last 60 years, precious metals like gold and silver have actually beaten the S&P 500 more than half the time. That's not just a random fluke. It's often a sign that people are looking for a safe harbor from currency debasement. It's another huge clue that the stock market's rise isn't entirely built on a rock-solid economic foundation.
Which, of course, brings us right back to where we started. After digging through the data and looking behind the curtain, what's the real answer to our big question?
So, to wrap up the Austrian argument, a boom that's fueled by a printing press, instead of by real people saving real money and creating real things, doesn't actually create any new, sustainable wealth. All it does is shuffle existing wealth around, usually upwards, and inflate the prices of assets, creating a beautiful but ultimately fake mirage of prosperity.
And so we'll end with this final thought for you to chew on. If the price tag on your house goes up, and the number in your 401k goes up, but your ability to just afford daily life keeps going down, what does that really mean? Are you actually wealthier? Or are we all just being fooled by a yardstick that keeps shrinking? It's a critical question we all need to be asking ourselves right now. Thanks so much for watching.